You just brought home a brand new appliance. And this morning, Bob told you why you need it. And you can't wait to use it right now. But before we get to that point, we've got to go through the instruction manual, and that's what we'll be doing for the better part of today. There are several approaches to market timing or to market forecasting. One of the more familiar approaches is that of fundamental analysis. Fundamental analysis is a method which looks at factors that are external to the market in question. Factors such as net asset value, book value, new products a company might be coming out with, who the chief operating officer of the company is, price-earnings ratios, overseas expansion, cost of production, new areas of research, all factors that are external to the market. A second approach, with thankfully a smaller following, is that of technical analysis. Technical analysis follows factors which are internal to the market that is in question. Factors such as volume, advanced decline statistics, open interest, put-call ratios, sometimes even the price patterns of the markets themselves. All these internal factors are created by the market itself. I'm a realistic kind of guy. Any approach that's successful is fine with me. Some people are very successful simply trading off the news. As you can see here in this cartoon. Now, there is one approach that has worked for over 50 years, and it still works today, and it will still work tomorrow, and that's the Elliott wave principle, and that's why we're all here this weekend. I've always had a fondness for games, and over the last 6 years, my experience with Elliott has allowed me to observe that many of the same concepts which existed in some games that were very familiar to me were also evident in the Elliott wave principle. Because it's sometimes helpful to grasp a new concept by relating it to an old concept that you're familiar with, I've chosen 3 games that I think are representative of those concepts, and I'd like to discuss them briefly. The first game is chess. And chess is basically a game of pattern recognition. Your ability to see ahead several moves in the game will be crucial to your success against your opponent, who's also trying to look ahead several moves in the game. The Elliott wave principle is also based on pattern recognition in the concept of wave counting. Your ability to assess the various paths that the market can move over within the parameters of Elliott, Bob talked about the rules earlier, will directly relate to your success in the markets. Now, in Elliott, these paths are referred to as wave counts, and we're going to be talking about those today. The belief that there is only one path that the market can take, and the refusal to assess other alternative paths, is a prescription that will get you into trouble. And we'll also take a look at that. The second game is bridge. Now, bridge is a very structured card game with 2 basic rules. There are 4 suits: spades, hearts, diamonds, and clubs. And when a suit is led, it is required that the other players, or that all the players at the table, follow suit. Otherwise, the player is reneging. Additionally, there is a trump suit which is declared just prior to the play of the hand, which can be played when you're void in another suit and win the trick in question. If you trump a trick when you're not void in that suit, you're reneging. You're not following the rules of the game as they're defined, and you're probably not going to be invited back to that table. Now, Elliott is also a structured system with a fixed set of rules. As Bob mentioned, wave 3 among waves 1, 3, and 5 can never be the shortest wave. Wave 2 cannot exceed the origin of wave 1. And wave 4 cannot overlap wave 1 within a 5-wave structure. There are some so-called practitioners of Elliott out there today who continually violate these rules, and they still proclaim to be using Elliott. They aren't, and they really shouldn't confuse those people who are interested in learning Elliott with a distortion of what is really the simple beauty that Elliott has to offer us. Now, one other aspect of bridge, which will lead us into the third game that we'll talk about this morning, is the concept of finessing a trick. Bridge involves bidding on the individual hands, which indicates strengths and weaknesses in those hands. Given the opportunity during the play of the game, a successful finesse will be achieved more often than not by correctly assessing the probabilities of where the cards lie. And when you're talking about probabilities, the first game that comes to mind is poker. I don't care if you're talking about 5-card stud, 7-card stud, 5-card draw. We're all taught from a very, very early age that you don't draw to an inside straight. It's a low probability outcome, and if you continue to do it, it may very well be an early night. Additionally, if you've got a handful of garbage with the 5 cards that you've been dealt or whatever you've drawn, you don't have to play the hand. You've got your initial ante at risk, and that's it. There's no requirement that you put additional money down on the table. Now, the guidelines and wave personalities that were described by R.N. Elliott over 50 years ago enable us to assess the probabilities that our wave count is correct. And in those cases when the probabilities are low across the board, as is typical in corrective patterns, your money is best left in your pocket. You don't have to play. Now, finally, a common thread throughout all these games is the psychology that's relative to the opponent. In chess, your opponent is seated across the table from you, sometimes with his back to you, but always across the table. In bridge, your opponents are seated adjacent to you. Your partner is seated across from you, so there's a subtle difference there. In poker, your opponents are seated around the table or the campfire. As long as the requisite gin bottles are there, it doesn't really matter. In the market, though, it gets a bit more interesting, because first you've got the market itself as your opponent. Then you've got all those tens of thousands of people out there who think they're at least as smart, if not smarter than you, or at least as lucky, if not luckier than you are, and they're all your opponents. But in the market, you've also got yourself as an opponent. You hear that little voice that's telling you you're wrong, and you start second-guessing yourself. And then you start wondering, well, this is what my analysis tells me about the market, but what about the trade deficit? What about the non-farm payroll figures? What about the revised GNP numbers that are due out a week from Thursday? Is Elvis alive, and will he testify against Drexel? It all combines to add yet another dimension to the game. So what do we have? We talked about chess. Chess is a game based on pattern recognition. We're going to talk about Elliott. Elliott pattern recognition is seen in wave counts. If you can't see several moves ahead in a game of chess, if you can't assess the alternate counts, you're going to lose your king and the game is over. We talked about bridge. Bridge has a fixed set of rules. Elliott has a fixed set of rules. They're not to be broken. If you break the rules, you're just not playing the same game. We talked about poker, which is based on probabilities. In Elliott, when we talk about probabilities, what we're looking at are guidelines and wave personalities. We'll look at those later this afternoon. If you continue to bet on low probability outcomes, it's going to be an early night. These are the 3 main topics that we'll cover today. And the underlying theme throughout all of this, which makes it all possible, is psychology. Now, that's the end of the introduction. Let me show you how this all fits together. Essentially, this section this morning will cover impulse waves. After lunch, we'll come back, we'll discuss corrective waves, and then we'll talk about rules and guidelines and wave personalities. Now, this is page, there's no need to turn to this. This is page 248 in your workbook, but I just want to put it up here briefly to show you that we're going to talk about impulse waves. There are a finite number of these patterns. Once you learn these, there are no more. That's all you need to know about impulse waves. Bob discussed the basics. He talked a little bit about Fibonacci application. So we're going to take a detailed look at each pattern that's possible under the wave principle. The idea here is to see how Elliott can keep you in the market when there's money to be made and to keep you out of trouble all the other times. Let's take a look at page 2.1. This is the basic pattern. And what you see here, in the up portion, waves 1, 3, and 5 are termed impulse waves. And waves 2 and 4 are termed corrective waves. Wave 2 corrects wave 1. Wave 4 corrects the action of wave 3. And the entire sequence, 1, 2, 3, 4, 5, is corrected by the sequence ABC. Let's flip to page 2. This is essentially the same chart, but what we see is that 2 waves of larger degree can be broken into 8 waves of the next lower degree, which can subsequently be broken into 34 waves of the next lower degree, and so on. What the Elliott wave principle states is that waves of any degree in any series can always be subdivided into waves of lesser degree or expanded into waves of higher degree. Let me just show you one example very briefly. Here's one wave up, here's wave 2 down. That's 2 waves. But this wave subdivides into 5, and this subdivides into 3. 5 and 3 is 8. Now figure 2.3 carries this phenomenon one step further. What you see here is a constant sequence of 5s corrected by 3s. Action followed by reaction. You've got impulse waves, which are movements in the direction of the main trend and subdivide into 5s. And then you've got corrective waves, which are movements against that trend and subdivide into 3s. That's on the larger picture. On the smaller picture, movements in the direction of the main trend, such as this one, subdivide into a 5-wave structure. 1, 2, 3, 4, 5. Movements against the larger trend subdivide into 3, such as this. 1, 2, 3 waves down. Now basically, for Elliott purposes, a bull market is an uptrend that is comprised of 5 waves. A bear market is the correction of that uptrend. And a 3-wave trend on the upside, in this case, should be considered a bear market rally. Against the larger trend, which in this case, if 1 degree higher is down, this 3-wave structure should be considered a bear market rally. This 3-wave structure, within the framework of this larger trend to the downside, would be considered a bear market rally under Elliott. All right, now we said there are impulse and corrective waves. And first, what we're going to take a look at are 5-wave structures. There are only 2 cases involved when you talk about 5-wave structures: regular 5 waves and diagonal triangles. That's all there are. Now first, 5-wave structures are the easiest ones to diagnose. These are where you make your money. They're your bread and butter. Now let's take a look at some simple 5-wave structures. Now, this chart should be familiar to you. This is page 115. And again, if you just jot down the page numbers, there's no reason to flip back and forth to these. This is a chart we just looked at in Bob's section. 3 impulse waves separated by 2 corrections. 1, 2, 3, 4, 5 waves up is a very nice 5-wave structure. Within the 5th wave here, 1, 2, 3, 4, 5. These are simple 5s. Another example can be found on page 117. And let me point this out now. I've got certain examples here to show you specific instances of all the different wave patterns that we'll discuss. The workbook is full of other examples. Here's a nice 5-wave structure in cocoa. 1, 2, 3, 4, 5. That's just a simple 5-wave decline appearing on that chart. Page 127, this is the stock market. Here's a simple 5-wave structure which completed primary wave 1 of the most recent bull market that we saw from 1982 to 1987. And finally, Here's an example of the gold market. Here's a very clean 5-wave structures up that ended in 1974. This is also from section 1. Those are just examples of simple 5-wave structures. Now let's move to page 2.4. Usually, one of these impulse waves will be an extension. An extension is an elongated wave where the subdivisions are nearly the same amplitude and the same duration. In other words, they're about the same size and they last about the same time as the other 4 main waves, which give you really a total count of 9 waves of a similar size, as is illustrated very nicely right here, lower left-hand corner. That's a typical extension. 9 waves, all pretty much the same size and lasting about the same length of time. Let's take a look at a real-time example of this same phenomenon. This is page 138. And what we see here is a 5-wave structure with an extended wave 1. In other words, within wave 1, which also subdivides into 5 waves of roughly the same size and duration as the other main waves in the sequence. Now, as we saw in the lower corner where the extension was not identified, this is a 9-wave structure. But it could also have just as easily been labeled. There are reasons that it was labeled in this manner, the guideline of alternation for one, but you could also just as easily have labeled this chart as follows, making that intermediate wave 1, intermediate wave 2, and then counting 1, 2, regular 3, 4, 5, and having intermediate wave 3 be the extension. Similarly, you could also have counted 1, 2, 3, putting intermediate 3 there, intermediate wave 4 there, and going 1, 2, 3, 4 with intermediate wave 5 being the extension, the extended wave. Now, in each of those cases, there are no rules broken. Wave 4 does not overlap wave 1, and the third wave is not the shortest. Let me show you why that works. This has been very helpful at times in counting a structure, because I don't always know when you're counting and you start going 1, 2, and you're looking at a wave that you think is subdividing 1 of 3, 2 of 3, and then it looks like it's still subdividing further, and you're going 1 of 3 of 3, 2 of 3 of 3, and it's harder, it's difficult to keep track. Here's a simple 5-wave structure. Now let's suppose that this wave has an extension, or let's say that the subdivisions are apparent. So what you really see is that. Now all I've done is extend wave 3. By doing so, what I did was add 4 waves to the structure. 1, 2, 3, 4, 5 with an extended wave 3. 1, 2, 3, 4, 5, 6, 7, 8, 9 waves. So what we see is that 5 waves carries the same message as 9 waves. Let's take it one step further. I think that's right. What we've done here is to further subdivide this wave, put an extension in it. Okay, I've taken the exact same picture and just extended the middle wave in each case. You've got 5 waves within the extension right here. How many total waves are there here? Well, there are 13. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And what we see by adding 4 waves again, because that's all you're doing when you're going from a straight line to a 5-wave structure, is adding a total of 4 waves. So what you see is that 5 waves carries the same message as 9 waves, which carries the same as 13 waves, and that works forever. Now, there are a different set of numbers for corrective waves, as we'll see this afternoon. But that's been a very helpful little tool in counting. Extensions occur in one and only one of the impulse waves, and that can be a big hint to the subsequent wave development that you expect to see. Let's take a look back at page 2.4. There are a couple of guidelines as far as extensions are concerned. After you've got an extended wave 3, such as you do in this case, you would look for a normal wave 5. Now, by normal, I mean it would be either equal to wave 1 or related to wave 1 by the Fibonacci ratio, and we'll talk about that more in detail later on. Additionally, if waves 1 and 3 are simple, in other words, if neither wave 1 or 3 is the extended wave, you should expect an extended 5th wave, especially under the instance where volume in the 5th wave is greater than the volume that you saw in the 3rd wave. That can be a very big tip-off. That's what you see here in this example. Waves 1 and 3 were basically simple. Wave 5 is the extended wave. Now, the extension itself, since it is a 5-wave structure, can also contain an extension within an extension. Let's take a look at page 2.5. Here's an example of a 3rd wave extension of a 3rd wave extension. In this case, primary wave 3, 3 in a circle, is the extended wave. Within that, intermediate wave 3, parentheses wave 3, is also extended. Page 2.6 is an example of a 5th wave extension of a 5th wave extension. All right, now this is not a chart that's in the workbook, and it just about fits on the overhead. This is an example. Actually, this is what Frost and Prechter drew 10 years ago, over 10 years ago, as a textbook illustration of an extension within an extension within an extension. Page 2.7 is this picture occurring in real time. I'm sure many of you are familiar with this picture. What we need to do, add an intermediate wave 4 down here, and then come up here just over 1900 again, and add an intermediate wave 5, completing primary wave 3. We did that, and then the market proceeded to do that, so that worked out real well. Frost and Prechter drew the picture 10 years ago. Here it occurred in real time just about 2.5 years ago. What you see here is an extended minute wave 3 within an extended minor wave 3 within an extended intermediate wave 3. We'll come back and talk about this picture later on. That's pretty much it for extensions. Let's take a look at page 2.8. Now here's something that you need to keep an eye out for. It's the concept of a failure within a 5-wave structure. Sometimes the 5th wave fails to make a new extreme beyond the 3rd wave terminal point. We've called them failures. It's really a bad choice of words, although I'll probably continue to do it since it's ingrained in my speech. They're preferably called a truncated 5th wave, because that's really what it is. It fails to move beyond the end of the 3rd wave. It is imperative that the 5th wave contain the necessary subdivisions to qualify it as an impulse wave. And this in turn will help verify your wave count. Now, failures are not uncommon, especially in waves of small degree. That's nice. Why are they important? Because they give an important warning that you're dealing with a market where there is either underlying strength or underlying weakness in the market. In a case of a bull market failure, when wave 5 fails to exceed the peak of wave 3, you're dealing with a market where there is underlying weakness. In a bear market failure, where wave 5, in this case, fails to take out the end of wave 3, you're dealing with a market where there is underlying strength. All right, now what's wrong with this lower picture? Well, if this is a corrective pattern and it ended a bear market and we're going to go make new highs in here, what do we know about corrections? They're never 5-wave structures in and of themselves. A portion of a correction can be a 5-wave structure, but the correction itself cannot be a 5. So this must have been, in this example, the end of a C wave. And that would be acceptable. Let's move to page 2.9. Page 2.9 is a real-time example. This is the stock market back in October of 1962 at the time of the Cuban Missile Crisis. This correction, by the way, ended primary wave 4 of cycle wave 3. But let's take a look at it a little more closely. Notice that wave 5 of C does not come down and take out the low of wave 3. All right, well, maybe it's a failure. What do we need to check? Let's see if it's got the requisite 5-wave structure, and it does. I've seen this on an hourly chart, so I know it can be counted in this fashion. But this is a very nice 5-wave decline. Now, A.J. Frost caught this low, diagnosed this as a failure, and had that low. What was going on back in October of 1962? As I said, the Cuban Missile Crisis. Well, what did the failure tell you? This was horrible news that this was going on and the country was in turmoil, and we'd pretty much been in a declining market for a year and a half at least. Well, once you saw the failure, the market told you that it was a market that had underlying strength. That's why wave 5 was unable to come and take out the low of wave 3. What took place? Over the next 3 years of uninterrupted bull market that followed from this low, the market roughly doubled as it went from about 550 to a little over 1,000. That's the message that you can get from a failure. Let's take a look at page 2.10. We'll take a look at the top chart first. What we're looking at here is the peak of the 5th wave relative to the peak of the 3rd wave. None of the peaks within the corrective waves are important to us. Wave 5 failed to move above the end of wave 3, which is a failure, and that indicated a market where there was underlying weakness, since it's occurring at the end of a bull market. And you've got the necessary 5-wave structure, again, within the 5th wave. So you've satisfied everything you need to do. What took place? Well, over the next 10 months, the Dow was not even able to mount one 5% rally, which was not a market that I would have liked to have been trading. And that's the message that you can get from a failure. We'll come back and take a look at the bottom of this page in just a moment, because if you notice, there's a diagonal triangle there, and that's what we're going to talk about next. We're on page 211. We've mentioned rules several times. Wave 2 cannot exceed the origin of wave 1. Wave 3 cannot be the shortest wave. Wave 4 cannot overlap wave 1. The only true variation in style to this is the diagonal triangle. Because in a diagonal triangle, each wave subdivides into a 3-wave structure within the diagonal. Now, diagonal triangles typically occur after a substantial move. Don't expect to see a diagonal triangle after a short, stubby type move. They appear in a very logical place after the market has moved too far, too fast. In a diagonal triangle, wave 4 can overlap wave 1, and it usually does. I would come just short of saying that it's a requirement, but I can't think of any good diagonal triangles that we've counted where wave 4 did not overlap wave 1. And you can see that right here. Wave 4 comes down and overlaps the price territory of wave 1. Usually, a diagonal triangle will develop a wedge shape between two converging lines, as you can see on the diagram. Although occasionally, you'll get a reverse wedge shape, We'll see a couple examples of that, but they're very uncommon. Now, diagonal triangles are very emotional patterns, and they are sometimes characterized by a burst through the trend line when the fifth wave is completing, and that is usually typified also by very poor market action, poor volume, churning, poor advanced decline statistics. Why are diagonal triangles important? They are highly reliable patterns for timing. They usually precede very sharp moves, and they often indicate the exhaustion of the trend not only 1 degree higher, as is normal for any 5-wave structure, but also 2 or 3 degrees higher, which means you could be getting ready for a very important move. Diagonal triangles are ending patterns. They are finishing something. And the subsequent moves are quite often sharp and dramatic reversals. Let me just mention one reason. If you think about this, it makes sense that wave 4 comes down and overlaps the price territory of wave 1. If the individual waves within the diagonal triangle don't have enough strength to trace out 5-wave structures, that argues that the entire pattern itself is one of weakness. Let's take a look at a couple examples. We're on page 212. Now, the chart at the top of the page is a chart of the American Stock Exchange Index, and the period that we're looking at is back through June and July of 1986. Diagonal triangle occurred here after a substantial move. Each one of the waves within the diagonal triangle subdivided into a 3-wave structure. They were clearly not 5-wave structures. You've got converging lines that were typical. What happened? Now, a diagonal triangle is an ending pattern. It's supposed to indicate a sharp reversal. Well, the American Stock Exchange lost 10% over the course of the next month. And that would be a nice move to catch. This chart at the bottom page is an example of an expanding diagonal triangle. Each wave subdivides into a 3-wave structure. The lines diverge in this case. And what this completed was the February 1980 peak, which led right into the Hunt Silver debacle. Over the course, this said it's an ending pattern. The fact that it's a diagonal triangle that completed. And it said, look out, you might be due for a sharp, dramatic reversal. Well, over the next month and a half, the market lost 170 points on an hourly basis. Now let's go back and take a look at the bottom of page 210. Let me just point out very quickly this little failure here that occurred at the end of this diagonal triangle. That can be a very powerful combination. And here's a classic example of it, the bottom of page 210. Here's a diagonal triangle that completed primary wave 1 of cycle wave 5 back in January of 1984. But within the triangle, wave 5 failed to move above the end of wave 3. So what do you have? You've got a failure within the pattern which tells you there's underlying weakness in the market already. You've also got on top of that a diagonal triangle which tells you that an important pattern is ending. It is probably ending now, and you can expect to see a sharp, dramatic reversal. This is a very powerful combination, and when you see something like this, especially at this degree, it carries a very important message. The market lost 160 points over the next month and a half in this case. There are times under Elliott when the picture is very, very clear. Other times, when you're in doubt, you should do nothing because these occurrences will take place. Let's flip ahead to page 213. This is from, I believe, the August issue of the Elliott Wave Theorist. What we're going to concentrate on right now is the right-hand portion of this chart. Here's a textbook illustration of a diagonal triangle taken from Elliott Wave Principle. Here was the market action in late June, early July of 1986. Notice the converging lines, the 3-wave structure. Wave 3 here is a double zigzag. We'll talk about those later. In each of the waves, wave 4 comes down and overlaps the price territory of wave 1. What took place afterwards? This pattern said we're finishing a pattern at least 1 degree higher, possibly higher, expect a sharp dramatic reversal. And we'll take a look at this page later on. This is page 251 in your book, but I'm only going to spend a moment on it. Here was the end of that diagonal triangle we just looked at. Here's the subsequent action. Sharp dramatic reversal. At this time, when this occurred, this was the largest single down day in terms of points in stock market history. All right, now we've taken a look at diagonal triangles as they occur in fifth waves. Let's take a look at diagonal triangles as they occur in C waves, because it's also permissible for diagonal triangles to occur in that position. These are charts of the stock market, 1980 through 1982. The top pattern completed primary wave D of cycle wave 4. This occurred basically 1980 through 1981. And here's a diagonal triangle occurring in the wave C position. Each one of these waves is best counted as a three-wave structure. The lines converge. The pattern suggests that you're going to see an important reversal of trend. As a matter of fact, this is what the market did over the next 3 months. And interestingly enough, this completed primary wave E within cycle wave 4. Let's take a look at the diagonal triangle within C, waves 1, 2, 3, 4, and 5. And each one of these structures is best counted as a three-wave move. Now remember what we said about the exhaustion of trend several degrees higher in regard to diagonal triangles. Because this last diagonal triangle here, which completed primary E of cycle wave 4, ended the 16-year bear market that lasted from 1966 to 1982. It was followed by the biggest kickoff rally in terms of momentum in over 40 years. That's the type of significance that a diagonal triangle can carry. Now, diagonal triangles themselves are rare. You don't see them all over the place. This is page 215. But a pattern that Bob observed several years ago, and we've actually seen several of them since then, is what we refer to as a diagonal triangle type 2. And let me also add that this is the only new pattern that we've seen in over 12 years of real-time analysis of the markets, and felt that it was a valid enough pattern to add to the catalog of patterns that Elliott gave us 50 years ago. These are rare patterns. Let me show you the difference between this and a diagonal triangle type 1. The odd-numbered waves, 1, 3, and 5, subdivide into 5-wave structures, unlike diagonal triangle type 1s, which subdivide into 3s. They still converge, and wave 4 still overlaps wave 1. Now, there are only several known occurrences of these, but interestingly enough, they have all occurred in wave A of an ABC rally, which was part of a bear market structure. And what that means is that each one was preceded by a very strong decline, and each one was eventually followed by another strong decline. So ultimately, these patterns imply weakness too, just like diagonal triangle type 1s. Let's take a look at page 216. The chart at the top, as it says, is a chart of the Dow hourly, November through December 1979. This was preceded, and let's take a look at the subdivisions first. This was best counted as a 5, 3, 5, 3, 5, as is required by the pattern. This advance occurring in an A wave was preceded by the October massacre in 1979. It led to a little further rally up here when we completed wave C. As a matter of fact, we looked at that a couple pictures ago when we saw the expanding diagonal triangle that peaked in February of 1980. And this was ultimately corrected by another strong decline, that being the Hunt debacle that led into March of 1980. This lower chart Again, 53535, the subdivisions occurred in April through May of 1984. This appeared in the Theorist as well. This was preceded by the February 1984 decline, which was the first decline coming off the peak of primary wave 1 that we just took a look at, and it was followed by the July 84 decline to Dow 1083.59 or change, which ended primary wave 2. And basically, that's all there is to know about impulse waves. And there's the summary. Talked about normal 5-wave structures. Extensions. It's an example of a failure. And then diagonal triangle type 1 and type 2. And this is page 248. Now let me say, most impulse waves are normal 5-wave structures with an extension in one of the subwaves. It's usually the third wave, except in very strong bull markets or in commodity markets, as Bob spoke about earlier. Then it's usually the 5th wave. Now, the end of a move comes when the 5th wave of the 5th wave of the 5th wave has finally been completed. And let me draw that. There's a 5-wave structure. That structure is complete when the 5th of the 5th of the 5th, however long it takes, is over. Occasionally, the 5th wave will be truncated, which means there's no move beyond the end of wave 3, but it must contain the necessary subdivisions. Now, confirmation that a trend change has occurred of a certain degree comes with a 5-wave move of one lesser degree in the opposite direction. What signals to you that this trend of this degree has changed is when you see this. 5 waves down, in this case, in the opposite direction. Okay? Diagonal triangles type 1, they're a special style of 5th wave. They have very specific rules. They can occur within a 5th or within a C, and they almost guarantee that there's an important trend change about to occur. Diagonal triangle type 2s are rare occurrences. They're special case, and they've only been seen to occur in the A wave position of an ABC corrective pattern, which otherwise has all the characteristics of the A wave of a zigzag. Now that's the end of the section on impulse waves, and we're going to take a little break now. Okay, thank you very much.